The crypto infinite money glitch appears to be broken, and we may never truly know what went wrong. The way it was supposed to work is that you could take an irrelevant company, raise capital to buy Bitcoin or some other token, they're all basically the same, then tweet something quasi-religious about the future of money and put a lot of effort into creating AI memes, as good AI memes will definitely drive the token price up. I mean, that's in corporate finance textbooks at this point. This starts the flywheel spinning. The crypto goes up, pushing your stock price up. Then you sell more stock to raise money. Buy more crypto, rinse and repeat. If there are any annoying questions about cash flow, PE ratios, or the fundamental laws of thermodynamics, that's possibly just a sign that you need to crank out more AI memes. Why run a business which is dull and boring and can go wrong in many, many ways when you can just buy something, tweet about it, and pump its price? I'm possibly making it sound too simple. One of the real innovations of crypto treasury companies, as they became known, was to monetize the volatility of your stock. If your stock price jumps around like a caffeinated squirrel or has a high standard deviation, as nerds would say, you could monetize that volatility by issuing low or zero coupon convertible bonds. The more volatile your stock price is, the more the embedded conversion option is worth. And the convertible bonds will be bought by hedge funds who don't necessarily believe in your company or the underlying crypto token, but they are able to make money through gamma trading, which I'll explain in more detail later in the video. But it involves buying a convertible bond, short selling the stock against it on a ratio so that you're market neutral, and then constantly adjusting your position size as the stock price moves around. The hedge fund can make money from this while keeping its combined position stock price neutral. These guys don't care about the company or the Shiba Inu-based token that you're claiming drives its value. They just care about the stock price moving around a lot, which your AI memes and unhinged tweets are supposed to cause. This is a virtuous circle, or some sort of a circle anyhow, as it allows the CEO of a once failing company to raise cheap capital to buy stupid tokens while providing hedge funds with profitable market neutral trading opportunities. Look, you can be as negative about this as you want to be, and I know you guys can be judgmental, but it worked like a cheat code in a video game, where companies could raise funds to buy crypto. That buying drove up the token prices. The firm's stock price often went up even more than the crypto did, as idiots would buy the stock. Your quasi-religious tweets and memes stir up your followers on the Everything app, were good for social media platforms, and provided a real use case for Sora too. This was hype capitalism at its best. Whether you like it or not, it's just how things work. It's maybe even how things should work, as why have a company that does something when you could just have a company that buys something and pumps its price up? It's better, it's more efficient. Over the last year, crypto treasury companies revolutionized the way that businesses worked. And while it started with MicroStrategy and Bitcoin, managers of other irrelevant companies worked out that you could stuff pretty much anything into this structure, as if you think about it, everything can be scarce if you raise enough money to buy all of it. The way I see it is that business has just been too complicated for too long. The guy with the high-pitched voice and the bitcoins worked out that businesses, if you separate them from business activity, can be much more efficient. Elon Musk, who spent billions of dollars on AI so that he could have a cartoon girlfriend, says that most jobs will eventually become optional, comparable to hobbies like playing sports or gardening. He explained at a US Saudi investment forum that this can all happen as long as we create an AI that cares deeply about truth and beauty. And you're not going to find a group that cares more about truth and beauty than the people attending an Elon Musk speech at a US Saudi investment forum. In this brave new world, where everyone is living large and no one is working, we're going to need our infinite money glitches to keep it all afloat. But the problem now is that the cheat code seems to have stopped working. Strategy is no longer trading on animal spirits. It's been dragged down by financial gravity. Since the company went all in on Bitcoin, it has hardly any other sources of revenue and now owes $800 million a year in dividends and debt interest payments. The massive premium to net asset value, which was the magic dust that made the share issuance accretive, has evaporated to a pedestrian 1.15 times. Worse than that, some of the copycat firms are now even trading at a discount to their crypto NAVs. Before we dig into what's gone wrong, let me tell you about this week's video sponsor, Saylor, an eSIM provider who makes it incredibly easy to travel and stay connected without having to pay ridiculous foreign roaming charges, find a local SIM card, or search around constantly for public Wi-Fi. I hadn't heard of this technology before trying out Saylor this summer, but it's an app that you install on your phone which allows you to stay connected in over 200 places around the world. There's no need to buy and swap physical SIM cards when you travel. You just download the app once and use it whenever you're abroad. You choose how much data you want and for how long. It's way cheaper than roaming and takes seconds to set up. You just select the country and plan and activate an eSIM before you leave home. And when you land, your phone automatically connects to a local network with no hidden charges. There's no fussing around at the airport. You can book an Uber, access GPS, or make a call. So if you've got travel plans, click the link or scan this QR code to download the app. Choose a plan in the country you're going to and use my code Boyle at checkout to get an exclusive 15% discount. Look, no one loved the crypto boom more than me. I loved the people. SBF and Caroline the Wood Nymph provided endless entertainment. There was the art, the games, and of course the music. Who can forget the music? A lot has changed over the last few years, however. The people are now politicians. One is even a FIFA laureate. And SBF went from being the most generous billionaire to a guy who can't even afford to buy himself a pardon. Presidential pardons in 2025 became the new NFTs. If you're big in crypto, then you'll have a collection of them framed on your wall. To understand the strategy collapse, you have to understand the bizarre arithmetic that drove the boom. The entire strategy trade relied on a single fragile variable, the premium. For most of 2024 and 2025, investors were willing to pay around $2 for every $1 of Bitcoin on Strategy's balance sheet. Why? Because Strategy offered something you couldn't get elsewhere, leverage without the margin call. If you took a leveraged position in Bitcoin on an exchange and the price crashed, you got liquidated. If you bought Strategy stock, you got loads of Bitcoin exposure, but if it tanked, you still had a huge loss, but you could hold on to your position and hope for a bounce. I made a video about crypto treasury companies last summer, and in the comments section, Strategy cheerleaders were arguing that the business was valuable and should trade at a premium because without it, investors couldn't easily get leveraged exposure to Bitcoin. But even then, there were more than 100 other companies already doing the exact same thing, many at lower premiums. It just didn't make sense to pay $2 for a dollar's worth of Bitcoin. This premium above NAV was a good thing, according to strategy investors, however, as it created a recursive loop. If the stock trades at $200 but represents only $100 of Bitcoin, the company, they said, could issue a new share at $200, buy $200 worth of Bitcoin, and suddenly the Bitcoin per share of the existing holders or hodlers went up. The way investors saw it, dilution was actually accretive. It was a magic trick where the more stock Strategy sold to buy Bitcoin, the richer the existing shareholders became. As of the time of this recording, Bitcoin is trading at around $90,000, which is down about 5% year to date. That includes dividends and other cash flows. Strategy, on the other hand, is down around 40% year to date, which is worse. Strategy is and was a very volatile stock. While it wasn't an S&P 500 member, it was more volatile than any other stock in that index, even meme stocks like Tesla and Palantir. Its high volatility enabled the convertible bond issuance that I described earlier. But for a certain type of investor, the most volatile stock wasn't volatile enough. Retail traders piled into leveraged single stock ETFs tied to strategy like MSTX and MSTU, which are down around 85% year to date. According to Bloomberg, that puts them among the 10 worst performing funds in the entire US ETF market, out of more than 4,700 products currently trading. One of these leverage strategy ETFs, MSTP, was only launched in June and is down almost 85%. If you invested in these, you should probably keep quiet about it so a court doesn't order Britney Spears' dad to look after your money for you. Bloomberg reported earlier this week that investors in these three leveraged ETFs have lost around $1.5 billion in assets since early October. At the peak of the crypto treasury company craze and the leveraged ETFs that loved them, Robin Wigglesworth wrote in the FT about the launch of the Bonk Income Blast ETF with the subheading, "Every day we stray further from God's light." The article quoted an SEC filing for an ETF that would invest in Bonk, the social layer and community meme coin of Solana, with deep integrations as a utility token across a wide base of application and protocols within the Web3 ecosystem. Fortunately, no one has lost money on this one yet, as it's still waiting for approval. But its goal is to buy Bonk call options and sell Bonk put options to generate the full Bonk upside that you would get by simply buying Bonk, but with potentially greater capital efficiency, by generating Bonk-derived income. The prospectus does warn of the potential for significant losses if the price of Bonk declines. Anyhow, copycat crypto treasury companies who are underwater on their crypto purchases have started dumping tokens to fund stock buybacks or to service debt. The FT reported that NYSE-listed chipmaker Sequence sold $100 million worth of Bitcoin to pay creditors just 4 months after pivoting to a digital asset treasury strategy. Its CEO told the press, "Our Bitcoin treasury strategy and our deep conviction in Bitcoin remains unchanged." Metaplanet, Japan's biggest Bitcoin holder, raised a $130 million loan against its Bitcoin stash after its stock fell 80%. Smarter Web Company, the UK's poster child for crypto treasuries, is down 44% and trading at a discount to the crypto it holds. But amidst this graveyard of copycats, there was one hilarious exception: GameStop. When the original meme stock king announced that it was pivoting to a Bitcoin treasury, the stock actually fell 10%. Why did this happen? Well, because unlike strategy, GameStop has an actual business, sort of. It sells video games and Funko Pops to people in shopping malls, not all of whom are also GameStop shareholders. The market realized that if you have real revenue and real customers, you're judged on them. It turns out that the infinite money glitch only works if you're a hollow vessel. If you're empty inside, you can be filled with dreams. If you sell used copies of FIFA 2019 for $4, you're just a retailer with a strangely volatile balance sheet.
The entire machine is like a quadratically reflexive engineered instrument. And you could say, well, Michael, you're a financial engineer. Yes, I am.
Strategy, however, has a strategy, sort of. Last weekend, Michael Saylor posted a stock price chart covered with orange dots, which highlight when the company bought its bitcoins, with a teasing question: what if we start adding green dots? The implication was that he might buy dollars. For a company whose chairman famously compared the dollar to a melting ice cube, hoarding fiat currency is a stunning capitulation. This Monday, the company announced that it had issued $1.4 billion of equity not to buy Bitcoin, but to build a dollar reserve to cover the dividends on its 5 classes of preferred stock for the next 2 years. Now, Michael Saylor does have a point. Issuing stock to raise cash is a lot like issuing stock to buy Bitcoin, but cash has a special use case where it can be used to make payments and even buy stuff, even stuff that's not available on the dark web. At a high point in the crypto treasury company mania in October 2024, MicroStrategy's chief executive officer, Fong Li, explained on an earnings call why they were selling a record $21 billion in new shares to fund crypto purchases. He explained that the dollar amount related to the children's book, The Hitchhiker's Guide to the Galaxy, where a supercomputer explained that the meaning of life is the number 42. He went on to say, "We believe it's a unique number with some special characteristics. It's the sum of 21 plus 21. We all know that 21 is a magical number in the world of Bitcoin. There can only ever be a maximum of 21 million Bitcoin in circulation." An actual CEO said this on an earnings call in all seriousness, and people, actual adults, had to listen to it without pointing and laughing because that would be rude. I needed to be sure, so I Googled him because maybe they actually put a little boy in charge of the company. But here he is on the strategy website, and the AI picture seems to be of a grown man. There was probably an analyst on that call, straight out of Harvard Business School, maybe on his first day of work, turning to his boss saying, "I think we're on the wrong call. I think this is some sort of dial-in horoscope lucky numbers line. You dialed 1-800, right? Not 1-900. We might be being charged for this." He possibly wondered if he was being hazed on his first day at work with a fake earnings call, like the way construction workers will prank the new guy by sending him around the site looking for a left-handed hammer, or getting him to return the 2x4s that aren't 2 inches by 4 inches in dimension. The stock didn't even crash that day. In a normal world it would have, but over the last few years a different type of person started investing. So why the sudden love for the dollar? And why $1.4 billion? Is that a children's book reference that I'm not aware of? Maybe it was the number of wands Harry Potter owned in Harry Potter and the Chain of Blocks. I haven't read that one.
You know those Harry Potter books? You know they're for children, don't you? They're aimed at children. The Harry Potter. They're children's books. People go to me, "Have you read the new Harry Potter book, Stu? It's good if you read it." No, I haven't read it, because I'm a 40-year-old man. You should read it, Stu. It's about a wizard in a school. I'm not reading it. I'm an adult.
Well, the thing is that the company has issued preferred stock with aggressive names like Strife, 10% coupon, Strike, 8%, and Stretch, a variable rate currently near 10.75%. These dividends are high, and they mean that the company needs to come up with hundreds of millions of dollars every quarter. For a while, they were issuing stock, not at a huge premium, but Bitcoin was still going up. And if you issue stock at 10% to buy Bitcoin, which you think will go up at more than 10% a year, then that's an accretive trade. But if Bitcoin goes up by less than 10% or falls, then you're still paying that 10% a year to those investors and destroying value. Now, technically, these are dividends, meaning that the company isn't legally obliged to pay them. They can choose to accrue them, but doing this would likely torpedo the company's ability to raise any more capital for quite some time, ending the game immediately. So strategy is stuck. It's now selling common stock to raise cash so that it can make dividend payments to preferred shareholders. Now, when you start raising capital from new investors to pay out old investors, your strategy starts to seem like more of a scheme. As Bloomberg's Matt Levine noted, we're selling billions of dollars of stock at a premium to NAV to buy Bitcoin is maybe a great story. We're selling $1 billion of stock at NAV to pay interest on the loans we previously took out is considerably less fun. For strategy, if there is no recovery in the price of Bitcoin, the real pain will begin in 2027, when the firm's convertible debt starts to mature. Its borrowing right now is modest relative to its assets, but its lack of alternative sources of income may force it to start selling its Bitcoin. So why has crypto been tanking recently? I don't really know. It doesn't really do anything. It's just a number to bet on. It's not even that useful for illegal payments, as things like stablecoins are better at that. So the price of things like Bitcoin just rise and fall based on whether people think it'll rise or fall in the future. It seems to have become highly correlated with tech stocks, but there's no real reason to believe that that'll continue. In 2013, Joe Weisenthal wrote a column called Gold is a Bet on Human Failure, where he argued that buying gold is a negative economic act because it represents a bet that a shiny rock will hold value better than the collective ingenuity of the human race, represented by stocks and productive companies. He argued that when investors buy gold, they're essentially hedging against total political breakdown and the failure of peaceful human interaction. He has since extended this logic to include Bitcoin, which he describes as an even more profound form of shorting the system, arguing that Bitcoin's appeal is based in a complete loss of trust in state capacity and institutions. The Economist wrote a good piece last month called Crypto Got Everything It Wanted, Now It's Sinking. In the piece, they argued that the crypto industry has gone from being an object of mockery to being broadly accepted by politicians and regulators. But this victory has created a paradoxical problem. The thrill of the chase is over. Every major rally in recent years was fueled by the anticipation of specific milestones, like the approval of ETFs or the backing of a friendly US administration. Now that those battles have been won and investors have no trouble getting their hands on Bitcoin, the market has exhausted its most potent bullish narratives. Without a new catalyst or a forbidden fruit story to sell the next wave of buyers, crypto is left as a purely speculative asset with no fresh reason for the number to go up. One of the reasons for thinking Bitcoin could go up forever was a belief that Strategy's infinite money glitch would work. My friend Zeke Fox appeared on Dan Toomey's YouTube channel a few weeks ago, and if you haven't watched that video, you should. I'll put a link to it in the description. In it, he explained his juggalo theory of Bitcoin resilience. Zeke argued that Bitcoin has developed a fan base as committed and impervious to outside criticism as the juggalos, the die-hard insane clown posse fans, who dress up as clowns and attend an annual gathering. I should mention that Dan Toomey is a huge ICP fan, so don't say anything bad about them around him. Zeke argued in the video that much like the way you wouldn't bet against the juggalos attending their big meetup every year, you shouldn't bet against Bitcoiners showing up to support the Bitcoin price, or showing up in my YouTube comments section to say that Bitcoin is somehow not the same as crypto. They are a cult, according to Zeke. That puts a floor on the asset price simply by refusing to leave. But Zeke then adds a critical twist to the analogy. Unlike the juggalos who congregate for the love of the culture, Bitcoiners have a powerful financial incentive to evangelize. What if by recruiting more juggalos you would get rich, he asks. If bringing in new fans directly increased your net worth, you would work a lot harder to recruit them, and suddenly the music might start to sound a whole lot better to you. It'll be interesting to see how things work out for Strategy. There's no underdog narrative left to drive the price. There's no institutional wall left to breach. Strategy issued so many convertible bonds that the gamma hedging, where the traders buy the stock when it falls and sell it when it rises, killed the volatility. The SEC is no longer the villain anymore. It's just a regulator, and a regulator run by a crypto guy. The US Secretary of Commerce is a crypto guy too. BlackRock can't be viewed as an enemy either. It's just the custodian. And the US president isn't just on side, he's attained almost all of his wealth from crypto. If there are no walls left to breach, we're just left with Michael Saylor tweeting that Bitcoin is a swarm of cyber hornets serving the goddess of wisdom, feeding on the fire of truth. I'm not sure if that can be classified as a sentence, if it makes no sense, but that's what he said. For now, the cyber hornets are quiet. The premium's almost gone, and the infinite money glitch may have been patched. And strategy investors have been learning the oldest lesson in finance. Leverage works both ways. The Ouroboros has finished eating its tail, and it turns out it wasn't very nutritious. If you found this video interesting, you should watch my video on AI's circular financing bubble next. Don't forget to check out our sponsor Saylor using the link in the description. Have a great day and talk to you in the next video. Bye.